Great. So as you all know, we're going to be talking about lazy money today. So lazy money, we think is a really, really simple topic. And it's something that, gosh, I just let my money sit there in a checking or a savings account. It's liquid and it's there if I need it. So, but there is a possibility of having too much of that. And that is a concern now. And we'll address some of those concerns. So Audrey is in here with me. She's going to be keeping an eye out for questions, and I'll stop every at the end of a point or at the end of a slide, and we'll answer those questions as they come in. So you can go to the chat function on your Zoom, and whatever questions you have, just type those in, and we'll make sure that we answer all of those as well. So, but first, I think it's important that we define lazy money. What is lazy money? And if we were in person, I would ask everyone, and everyone would have the perfect response because we all have been to educationals and webinars before, or seminars before that discuss this. But essentially, lazy money is our money that is sitting in savings and checking and money market that's not doing anything for us. So it's not making any money, it's not growing, it's not paying any interest, especially these days. So that's lazy money defined. So why is it important for us to have this webinar right now? So the importance of this is with inflation, last month, so September 2021 inflation data, depending on your source, was between 4 and 5%. So that's significantly higher than the Fed's target of 2%. We have high inflation on one hand, and then on the other hand, the Fed still is keeping rates low, interest rates low. So we're having record inflation, and our lazy money is making 0.02% in most cases. So the purchasing power of those dollars is being eroded very quickly. I just realized that I cannot scroll through slides on this. So that's okay. Yep. All right. So, like I said, inflation's high, interest rates are low. So what do we do with our lazy money so that so it's not being eaten up by inflation? So we have our disclosures here. Just like any other web or seminar we do, we put these up, everyone reads it in detail and they know exactly what it says, but essentially what it says is we talk about some general topics here. Nothing we talk about is going to work for everyone. So if you go and try to execute this on your own, it could cause you it could unravel some other problems. So we just want to make sure that you're talking to your financial professional or talking to us before executing any of the strategies we'll talk about today. So I want to start by talking about the perfect investment. So what's the perfect investment? And again, if we were in person, everyone would raise their hands and they'd be shouting all kinds of answers at us. But, for me, perfect investment, I want my money to double every year. I want it to be fully liquid, and I want it to be guaranteed. So if I could have those three things, I'd mortgage my house 3 times to get that kind of investment. Unfortunately, we're not able to do that. There's the big 3, liquidity, growth, and insurance or guarantees. Those are the big 3, and you have to give up at least one of the big 3 to have the other 2. So, no perfect investment. If you want liquidity, you're going to give up some growth. If you want growth, you're going to give up potentially some liquidity and guarantees. So just keep that in mind. No perfect investment. So And this is just talking about the perfect investment again. Now, when we talk about our money, and this is about lazy money, but there are some other buckets of money. So we like to think about our asset allocation in three buckets. There's lazy money, there's growth money, and then there's paycheck money. And we'll have a slide here in just a second that's going to show you those three buckets. Now, there are some percentages on this slide, but keep in mind that, again, everyone's situation is different. So you may need a little more lazy money than growth money. And then, if you're younger, you may want a ton of growth money, some lazy money, and almost no green money. But here's our three buckets. We got our yellow lazy money, which is what we're really going to talk about today. There's green paycheck money. So that's our bonds, our structured notes, things that are going to pay us interest, but not really going to grow a whole lot. And then there's our red or growth money. That's going to be stocks, ETFs. Some structured notes are growth oriented as well. So that's our red money. And these percentages change as you go throughout your lifetime. So, as you're younger, like I said, more yellow and red money. And then as you hit retirement, you're not receiving a paycheck from a job anymore. So you're going to want to get that green or paycheck money situated. So now our lazy money, under here we have checking and savings, money market, and CDs. And actually at the end of today, we'll talk about a couple of alternatives. They give you liquidity and a chance to at least not be eaten up as much by inflation. And like I mentioned before, inflation is about 4% for September. So at the Fed's target of 2%, we can say prices double about every 25 or 26 years. Now at 4%, we're cutting that in half. So now we're looking at every 12 and a half or 13 years, prices would double. So if this is a prolonged inflation or prolonged, we have inflation for an extended duration, there could be some issues with your lazy money there. So today's all about what can we do to earn extra on our lazy money. Any questions? Yeah.
Actually, could you switch so participants see full screen and see what the presenters view?
How's that? We had a question to switch to where the presenter's not big in this, or the slideshow should be bigger. So that work?
I think so. He hasn't responded though.
Good. Okay. So, when we talk about our buckets of money, we're looking at priorities. So what is our priority? Do we want a bunch of liquid money? Sometimes, yes, if you're going to make a big purchase, or you're potentially a business owner and you need some liquidity. Yes, we do want some some protection and fully liquid money there. Then we have our paycheck money. Again, that's going to be protected. It's not going to be insured like FDIC insured, like your liquid money, but it will have some protection around it. And that's going to provide you income. That's going to be the heavy lifter for your income. And then your growth money, that's your risk. Your risky money, that's where you're going to experience you should experience the most growth in your bucket of red money. So now the big question is, how much liquidity do I need? This is a great question. And how do we figure this out? If you go by most people, 3 to 6 months of cash in your checking and savings is what you need for that emergency fund. And that depends, if you're retired, maybe you want more on the 6-month side. If you're a single income household, you definitely want more like 6 months. If you're a double income home, you can skew more towards 3 months. But those are, pretty safe ground rules, the 3 to 6 months. Now, we do run across clients a lot of the time that we sit down and they're like, well, gosh, I have $400,000 in my checking account. Like, well, that's probably a little bit too much. And that money is being eaten up by inflation. It's not doing anything for you. And then the other issue there is the FDIC insurance limits are $250,000. So you've exceeded that insurance limit as well. So all things to consider whenever we see our yellow money, our checking account balance grow.
We have a question.
Right.
What exactly is liquidity?
So liquidity is your ability to get to the money quickly and have it be worth what it was when you put it in. So, you put your money in your checking account is not going to lose money. The dollars in there are not going to be worth less when you put it in there, because now you'll spend money from your checking and the balance will go down, but the actual, there's not an investment that decreases in value and eats away at your purchasing power. So, the ability to get to it quickly, and then, it's not a risky investment. It's insured, completely safe. That answer the question?
I believe so.
All right. So we talked about the 3 buckets, yellow, green, and red. Now we want to, with our yellow money, specifically, we want to prioritize liquidity. So that was a great question. Glad that we were able to define liquidity. So that's rule number 1. Rule number 2 is yield. We don't want to have a shoebox full of cash that we bury in the backyard, because it's getting 0 yield at that point. So you don't want to bury it anywhere. You want to seek out somewhere that's going to pay you some interest so that money keeps up with inflation. And then number 3 is don't overdo it. Like I mentioned before, we've sat down with clients that have $300,000 or $400,000 of cash in the bank, and that's overdoing it. You can have the greatest disaster known to man all happen in a week span, and you probably won't spend $400,000. So don't overdo your yellow money. Now, these rates are a little bit old. I actually looked up some rates this morning. Most money market or high yield savings accounts I'm seeing right now are less than 0.5%. So we're talking 0.45, 0.4%. American Express may still be 0.5%. But the story there is interest rates are super low. Now, CD rates, people will ask us a lot of times, what are the CD rates right now? The best CD rates I could find were through Sallie Mae. And as of this morning, their 1-year CD was paying about 0.6%. Their 18-month CD was paying 0.65%. You actually have to go all the way out to a 3-year CD to get 1% on CDs right now. So, again, we all know we're all aware CD rates and our checking rates stink right now. And so what else can we do? What other options are there? All right. So if rates are so low, what can we do? So the first thing, and we bang this drum a lot, have a plan. So, having a plan means knowing how much you need, how much yellow money you do actually need. Now, if you like to have a little bit of extra yellow money, that's where we start to get in trouble, and that money starts to be eroded through inflation. So having a plan is very important. Second thing, remember the rules: liquidity, yield, don't overdo it. That's the 3 rules of our yellow money. And then remember the rule of thumb. The rule of thumb, 3 to 6 months of cash on hand. That's about what you need to handle any emergency that may arise. So we have our 3 to 6 months, but like I said, some people like to have a little bit of extra cash. So what do we do, or what other options are there so that we can achieve higher rates? So the first is a MYGA. So MYGA stands for multi-year guaranteed annuity. We typically think of annuities as these long-term contracts, but money's locked up. They're very expensive. But in this case, a MYGA is very simple. It behaves like a CD. It's not insured like a CD. So I don't want to misconstrue that, but it is guaranteed by the insurance company that issues that contract. And right now we're seeing rates of 2.35% on the 3-year. Now there is some liquidity restrictions, but you are able to go in and get 10% of the contract value every year. So there is some liquidity inside of that contract. And then if there's a long-term care event, most of these contracts allow you to pull the full amount out if you do need long-term care without paying any penalty. So we have a question?
We do. What about investing in precious metals, gold, and silver?
All right, so the question is, what about investing in precious metals? So gold, silver, platinum, palladium I've seen out there. I don't dissuade people from doing it, but you don't want a large chunk of your investments in there because we've seen over the last 5 to 10 years, commodities, gold, silver, platinum can be very, very, very volatile, just like the market. So, if you buy gold at $1,800 an ounce today, next month, if inflation starts to tick down and the market continues to go up, your gold may now only be worth $1,500 an ounce. So, we want to be very careful when it comes to precious metals. Now, that's not to say absolutely don't do it. It is good as an insurance policy, but as a core strategy, I would not encourage precious metals as a core strategy. So good question. So MYGAs, they're actually very simple to understand. They just, the 3-year MYGA that I talked about just pays you 2.35% interest per year for 3 years. The contract is over. It's fully liquid at that point. You can take the money and go on vacation or do something fun with it. The other great thing about this MYGA is that interest is tax deferred. So you actually don't pay taxes on that interest until you pull the money out of the contract. And then the abbreviation below that, LI. So I did not want to type this word out because it's an evil, evil, evil word. People hate talking about this. It's very, very boring. But it's life insurance. So, life insurance as an alternative for my cash, it's not something that we typically see. But there are actually a couple of life insurance contracts out there that are fully liquid. They may require some underwriting, but they are fully liquid. They give you a chance for really, really great interest as well. So those are the things to remember. And when I say fully liquid, I mean, you put in $50,000 today and you need it next week, you can pull that out without paying a penalty. So it's a little bit newer and something that has been pretty popular over the last couple of months. So I've got some examples here. I just went and found the compound interest calculator online and I put in some interest, and I don't know if we can see this. Are we able to see this?
It's pretty small.
Okay.
Can you zoom in on it?
Yeah, let me zoom in and how's that? Better. All right. So on the left-hand side, I have the MYGA, the multi-year guaranteed annuity rate, And on the right-hand side, I have checking account rates. I was pretty generous with the checking account. I said it's paying 0.04, which, sadly is being pretty generous today. So you can see on the left, and I just used $100,000 because that's a really easy number to use. It's nice and round. But on the MYGA, you put in $100,000 at 2.35%. And after 3 years, you've made $7,200 of interest. So $7,216. That's pretty attractive for something that's safe. It's not FDIC insured, but it is guaranteed by the insurance company. And it's going to pay you interest that's tax deferred. Now on the right, if you have $100,000 in your checking, paying you 0.04, after 3 years, now don't get too excited, $120 of interest after 3 years on 100,000. So that's, I know that's really exciting. We're going to be able to take a whole bunch of vacations on that $120, right? So absolutely not. So that's what I mean when I say that our purchasing power is being eroded. That $100,000 in 3 years may only buy $95,000 worth of stuff. So we're not even keeping up with inflation on this, on the checking account side. So
What recommendations for LIs? What are your recommendations for the LI?
So the question is, what's the recommendation for life insurance? And I actually have some screenshots on the next slide for that. So we'll get there in just a minute. But again, the MYGA is pretty simple. Now the opportunity cost. So we say, gosh, I have to lock my money up for 3 years. Yes, but you can get to 10% per year for the 3-year contract. Now what's your opportunity cost of leaving that money in the checking account? So deciding to leave that money in your checking account rather than go into something like this MYGA or this guaranteed annuity, the opportunity cost is $7,096. So almost $7,100 over 3 years is what it costs you to leave that money in your checking account. So that's pretty impactful. That's $7,100 extra that you could have to spend money, go do something or reinvest or whatever you want to do. But it's a huge opportunity missed. So here I've done the same comparison for y'all. We're looking at the left-hand side now is the life insurance that we talked about. And again, remember, this is fully liquid. So you can go in and get your money out as soon as you put it in, if you need it. So now, like I said, with life insurance, there is underwriting. Some of these have accelerated underwriting, so we can actually go in and we can apply online. We usually get an answer within about 3 minutes of whether you're approved or not. And then we finish the application, and that's really it. Now it is life insurance, so you do have a death benefit there, but it's also going to give you interest. Now there's 3 columns here. First, we'll talk about the client. So his name is valued client, male, 68 years old. And we always show these as standard underwriting. So people will ask what that means. That just means about 80% of Americans are going to be approved at standard. And then it's a $100,000 premium. Again, it doesn't have to be $100,000. That's just a really easy number for us to work with. Now on the top left there, you see our guaranteed values. They say guaranteed because that's the only thing they can guarantee. There's never been a situation where this scenario actually occurs. So there is some, this is where they charge you the maximum amount they possibly can for life insurance, which doesn't happen or has not happened. And then also assuming the market does absolutely nothing over this period, and you're getting the 2.5% interest per year. Then we have our non-guaranteed alternate. So this is just saying current insurance charges, which is the most likely scenario. and then having that 2.5%. And over 3 years, you can see you still made $1,081. Now, that's still $1,000 more than what you would have made in a checking account.
Is there a minimum to start life insurance?
Yes. So the question was, is there a minimum to start life insurance? The minimum premium on this life insurance policy is $20,000. So, $20,000 in, and you let it grow. So, good question. So back to the scenarios, the non-guaranteed alternate. Again, current insurance charges. So what you have to pay for life insurance is what it is now, but the market doesn't grow at all. You're just getting that 2.5%. And in 3 years, you still end up better than leaving that money in the checking account. Now, there's also just the non-guaranteed side, which has our current insurance charges. And then this is actually an index policy. So if anyone's familiar with indexing, it's just going to give you interest based on how a market index does. So, it's not directly in the market, so your value is not going to go down when the market goes down. It just is going to credit you interest based on how that index does. And you can see after 3 years, this is going to average, this index selection is going to average about 6.16% per year. So after 3 years, you've actually made $12,000, almost $13,000 of interest. So when we're talking about opportunity cost and being completely liquid, the opportunity cost of having this money in your checking account versus in a life insurance policy like this, it costs you about $12,700 over 3 years to choose to leave that money in a checking account. So you can see, again, massive, massive, massive impact on our purchasing power.
Can you re-explain the difference between guaranteed and non-guaranteed?
Yes. So guaranteed is assuming that, I'm sorry, let me repeat the question. So the question was, can I explain again the difference between guaranteed and non-guaranteed? So guaranteed is just, they're saying insurance charges go to the maximum they can charge by law. Again, that's a scenario that has never happened. Not saying it won't, but as people tend, as we go on, people tend to live longer, and they actually adjust the tables. And so cost of insurance actually, the cost of insuring someone actually stays about the same over time. So that's maximum charges. It's just what they can guarantee. They can't say we won't do it, but the likelihood is very low that they will. And then the non-guaranteed is just using the current insurance charges. So what they're charging you for the insurance now is what they charge you later on. So another big thing with the life insurance, and something that we failed to talk about, is, we are talking about this as a place to put our cash, but there's also a death benefit. So if you never, ever, ever touch this and you were to pass away after 3 years, your beneficiary is going to receive $163,000 in tax-free death benefit. So that's $163,000 they're going to get without paying taxes. So that's another benefit, not the primary purpose of this webinar and not the primary purpose of this particular life insurance policy, but it is a great benefit to have, knowing that you're able to leave that kind of money behind tax-free.
How is the interest handled on the tax return?
Okay, so the question was, how is the interest handled on a tax return? And now I'm assuming we're talking about the life insurance, but it's handled the same way as the MYGA. So it's tax deferred. So you actually don't pay the taxes on the interest until you start pulling money out. So great question. So tax deferred, another huge advantage to putting your excess cash into something like this. And I know it's not the point of this webinar, but tertiary benefit or third benefit to this life insurance policy is you can actually access some of the death benefit early if you need long-term care. So just like with the MYGA, or the multi-year guaranteed annuity, if you have a long-term care event, they'll actually allow you to pull that money out without surrender charges. Well, in this case, you actually get a percentage of the death benefit in a lump sum to help pay for care. So great benefit to have. In this case, $163,000, you'd get about 72% of that in a lump sum to help pay for care. So, just another added benefit to this type of life insurance policy. We do have two carriers. I talked about the accelerated underwriting with United Life. North American actually has a similar policy, but it's fully underwritten. So, if you think, gosh, I've had some health issues, but this is something I'm interested in, we would want to go with more of the North American. If you're totally healthy and had no issues, the United Life may be a better option because we're just going to know a lot faster what the answer is on underwriting. So, yeah, I think that's it. These are all hidden slides. So we've had some questions throughout the presentation. I'm here. I'll stick around for a few more minutes. If there are any others, go ahead and type them in, and we'll get those answered for you. If there's not any, I appreciate everyone logging in and spending some time with us, and we hope to hear from you soon. All right, so there was a question about taxes again. So the question was, you only pay interest on the gains, but I think it was you only pay taxes on the gains. That's correct. So you pay your taxes on the gains. So in the case of the MIGA, you pull out the $7,000 or the $107,000 at the end of the contract, you would pay taxes on $7,000, not $107,000. So good question.
We have another question.
Okay.
What have the MIGA rates been for the last year?
So they've been pretty wacky, actually. So we get notices in our email inboxes about every week. And we've actually seen these rates fall from about 3% last year all the way down to 2.35. And actually a couple of months ago, the 3-year rates were even lower. They were around the 2.1, 2.15% range. But we've started to see them creep back up as there's been talk of raising rates over the next year and tapering some asset purchases.
Next question
Okay.
is, so it's better to put lazy money into life insurance than CDs?
So we talked about giving up one of the big three. So if you put it in life insurance, you're giving up a guarantee, and that's that FDIC insurance guarantee. Now, every state does have a guarantee association. So for a life insurer to do business in your state, they've got to be part of that association. So the state does guarantee up to a certain amount of your cash value, but it's not as strong as FDIC because we're talking about state government versus federal government. But if you asked me, absolutely. CDs right now are, we talked about it. CDs are not good right now. So, we're talking 0.6% versus or 1% over 3 years in a 3-year CD versus potentially 12% over 3 years. So massive difference. Looks like no more. Maybe I have a. Okay.
We have another one. What is the outlook of interest rates over the next 3 years?
Again, that's a great question. So what is the outlook on interest rates over the next 3 years? The Fed's talked about raising rates more than once over the next couple of years. So, slowly increasing rates. They have to balance that though with economic recovery, because if they raise rates too quickly, they'll tank the economy. So a lot of things to consider. I would not be surprised to see rates come up a little bit, but I would not expect a drastic increase in interest rates.
Thank you guys for the presentations. I hope more will come. I especially appreciate the Q&As. Oh.
Well, thanks for the comments. We appreciate it. And again, we appreciate everyone taking their time to spend with us this morning.
And if anyone has any topics they want covered in the future.
Yeah, so, we're always open to feedback. So if if any of our clients want to see a topic or a webinar topic, email us, let us know, and we'll try to put one together to address y'all's questions.
Thanks for the presentation.
All right. I'm going to leave it open for just a couple more minutes for questions, but I do appreciate the comments.